Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Dave Hendricks, founder and CEO of Vertalo, an SEC-registered transfer agent and registrar, or record-keeping business, for privately owned and managed issuers of digital securities. The goal of the company is to clear away the chief technical obstacle to private companies making their securities more tradable and more usable as collateral through digitization. Namely, the difficulty of moving data about a digital asset between different issuance and trading platforms. Dave, thanks for joining us.
Thanks for having me, Dominic. Looking forward to our discussion today.
Now, what in your personal career path brought you and your co-founders to this opportunity and this business?
My two co-founders, I've got two. One is William Baxter, he's our CTO, and the other one is Gautam Gujral, who's our general counsel. We've known each other for many years. Too many here. I'll date myself. But the interesting thing about us as a founding trio and how we got here was that we'd work together and we're complementary as kind of people. And one of the things about founders and putting founders together is it has to kind of be 1 + 1 = 3. There's got to be some kind of some overlap, but less redundancy. My CTO co-founder, William, he and I started working together 20 years ago, and I was the head of sales and marketing for an email marketing platform called Cheetahmail. He was the head of technology, and we built the world's largest email service provider called Cheetahmail. And we learned a lot about building multi-tenant systems where you could have, first of all, bring on lots of heterogeneous data and also have lots of different kind of competitors on the same platform. So you could serve parties that were, ostensibly competing with each other, but without any conflict. And so we were successful there, but we after the company was acquired, we ended up going our separate ways. My other co-founder, Gautam Gujral, our general counsel, he and I went to school together, and then he went on to the SEC after graduating from Georgetown Law, where he was instrumental in the authorship of Regulation ATS, which is the alternative trading system regulation that, T0, those kinds of companies, NASDAQ Private Market, Forge Markets, OTC Markets, so many other trading platforms run under. And my career, I started out at Arthur Andersen in the audit division, and I got involved in securitizations of assets starting in the early 90s, and actually worked on the Resolution Trust Corporation S&L crisis workouts. So I started building databases back in the 90s to transform assets for disposition. I then went to Oracle. I ran the worldwide relationship between Oracle and Arthur Andersen, so large database company, accounting company. And then I got involved in startups and as a principal and a co-founder in CRM and first-party data startups. And if you look at the world of assets, private assets, shares, it's essentially a bunch of first-party data. And it's very database driven and it's legal driven. And so my two co-founders, one's technical coder, the other one's a legal coder, and I'm the business and kind of product vision guy. And so we started doing this in 2016 informally, and here we are in 2022 and having a great time at it.
Mm-hmm. So you between you brought to the business a mix of skills, building ecosystems, knowing about data, knowing about law and regulation. But what brought you precisely to this opportunity? What's the history of Vertalo as a business?
Well, so the genesis of the business was that in my last company's Series D round, it almost blew up in diligence, and it was related to human capital due diligence. I managed to put together what ended up being a $35 million funding round. This is in 2015. And then I move over to London, and my CEO partner stayed in New York. It was a really interesting experience, and I never forgot it. And I was kind of looking to do the next thing. And so in 2016, me and William and Gautam got together in Berlin, and we started talking about some problems. The first thing we created, starting in 2017, was a due diligence platform based on Ethereum smart contracts. And we released that to my last company in July 2017. And then we thought about doing an ICO. Well, I wrote a white paper and a yellow paper, and I took this to Gautam, my general counsel. I said, hey, look, we can raise all this non-dilutive funding. You know, all the cool kids are doing it. And he took it to our lawyers at Lowenstein Sandler, and he came back and said, no ICO for you. So in October of 2017, when everybody else was doing an ICO, we decided to do a digital asset security, what some people call a security token offering, under Reg D and Reg S. And we created a subsidiary of the parent company. The subsidiary is called Vertalo in the Cayman Islands. We then started trying to raise against this early security token in early 2018. And we eventually issued so-called security tokens to 53 holders in March of 2018. But as a fundraising event, it was not very successful. The way we got to today's Vertalo was we saw there was a hole in the market. There were companies who were issuing tokens. You know, I call them token issuance platforms, and charging a lot of money for it. We saw companies being stood up to trade them over here. And we knew a lot about both these things, but what we found was that there was something missing in the middle. And what was missing in the middle was kind of a governance layer. It was a way for issuers to maintain a cap table and be able to transfer tokens and kind of manage that issuer to investor relationship. So in May of 2018, I said, oh, this other thing that we created is cool, but it's not catching on. And we pivoted in May of 2018 to build a platform, a digital asset data management platform that would be able to connect primary capital formation and digital assets with secondary liquidity. And that's kind of where, and I think that there was a very, very small market at the time, and it's still small on the tokenized side, but it ends up that actually it extends really well to analog securities as well.
I'll press you a bit on that digital asset data management platform answer in a second. Before I do, can I ask you a very trivial question? I've asked you about, it may be trivial, I've asked you about the history of the company. I'd like to ask you about the geography. On your website, it says you're in Austin, Texas, New York, and Seoul in Korea. Why those three cities?
Well, we were doing a lot in Seoul up until the health event that occurred over 2020 to 21, and that kind of petered out, unfortunately. The reason why was that was a very, very active and advanced market in distributed ledger technology, and had a great regulatory regime, and we had some investors and advisors there, and we spent some time there, and we had some good traction going, and then suddenly the thing happened, and that kind of petered out. I hope to get back to that. Austin, I started the company in London, and when I decided to really get it going, I moved my family from London to Austin because I ran a company here, and that's where my CTO William was living. And if you don't have a great CTO and a great business partner, it's hard to build something like what we're building. And Austin's a great place. You can see it in the background here. It's a fantastic place, and it's only 3.5 hours from pretty much anywhere in the U.S. New York. You got to be in New York if you're in capital markets. And so Gautam has lived outside of New York, and he's our guy who focuses on the street. And I expect that we'll grow as much in New York over the next couple of years as we will in Austin, because we want to be face-to-face with people, and that's where a lot of the action is.
Now, thanks for that. Back to that digital asset data management platform. Is that how you would describe the core business of Vertalo?
I would describe the core business as transforming illiquid assets into tradable and transferable digital asset securities. That's the core business, is effectively taking something over here, which is in a form that is not tradable, and moving it through our system so that it can be traded and transferred. In order to do that, you've got to work with data. And on one side, there's a whole bunch of unformatted or incompatible data, which is not ready for transfer or trading. And on the other side, there are places that want to trade and transfer the data. So what we do is we bring data onto our platform and we make it tradable and transferable. So I refer to that as digital asset data management. Now, it's probably more digital asset securities data management, but I'm trying to keep the acronym a little compact to the acronym, but that's basically what we mean by it.
Mm-hmm. So making things illiquid, does that mean that the natural target client base of Vertalo is private companies, and they might be startups, they might be well-established small and medium-sized enterprises, might be some other kind of private company? Is that your target client list?
So initially, our target clients were folks that want to raise money against tokenized securities. And that's where we had to start, because we had to work with other kind of pioneering startup type companies, because they have a high tolerance for newness, and they were very helpful. And we had more than 50 of those companies come onto our platform. The problem is that those if you work with early stage companies, not only do you have an execution risk and a financial risk, but the shares, early stage company shares, generally are not tradable. Not because for technical reasons or regulatory reasons, but because they're not worth much, and there's the enterprise behind a small offering is still fairly speculative. It doesn't have a lot of operating history, et cetera. But working with SMEs and kind of startups was great for us to cut our teeth, and it enabled us to learn a lot. And we're really, really thankful to so many of those clients. We're really more designed for companies that are stuck in this concept that I call the gulch of death. They're too big to get acquired in many cases, but they're too small to go public. But in this world, if you're a $500 million value asset, you're not going to get listed on a public exchange, on LSE or NASDAQ or NYSE. There's 15,000 of these companies, and as the IPO markets close and things change, what we're really targeted on in terms of clients are companies that have needs for secondary liquidity. And so that could be a real estate company that wants to fractionalize a property. It could be a venture funded company that wants to give secondary liquidity to its investors or its employees, or it could be a large financial institution that wants to take illiquid assets that are on its balance sheet and make them tradable. So it does scale up from the smallest company, but it's designed to scale to the largest assets for the most demanding financial institutions.
So is that the problem that Vertalo solves, this class of company that's the wrong size to either get acquired or to do an IPO, but who would like their liabilities to become tradable? Is that a good description of the problem you're solving?
It's a good description, but I'd also probably put a point on it and say we help with price discovery, and normalization. Today the typical model is a company stays private, and let's just stay with the venture funded model. That the typical company stays private, meaning taking private funding and not going public for 11 to 13 years for those who go public. And they go suddenly from a company that has, kind of random governance, depending on how they're set up, to having to suddenly account for themselves to the public. One of the value adds that we do is we create kind of a mezzanine liquidity opportunity, a way to put training wheels on private companies between being fully private and going public. And this kind of conditioning is helpful for the management team. It's also helpful when you go public, because if you run on a system like ours and you're trading on a platform like T0 or Forge or NASDAQ Private Market or Texture or SimBridge or these other ATSs, if you get a couple of years of trading history and quarterly disclosures, when it comes time to go public, or if someone wants to come and acquire you, you're really in much better shape to justify your valuation, because you've got, the investor sentiment, the buyer sentiment is well established, and you know how to file reports and things like that. So I think what we do is we're a staging area for data, and we're a staging area for companies who want to go to the next level.
Now, we've talked as if these company liabilities, these investor assets, making them liquid, making them tradable, that it's obvious what we're talking about here. But how exactly is Vertalo contributing to making this type of asset more liquid, more tradable in these secondary markets, these ATSs you've referred to? How would you say that you're contributing to that increase in tradability and liquidity?
So if you're keeping your share ledger on a spreadsheet, it's pretty much impossible to create a market. If you've distributed paper shares to your shareholders and they're holding them in a file somewhere, it's very difficult to create a market. And for the longest time, private asset markets have been essentially peer-to-peer or OTC. And there's no way to get distribution. There's no way to let a larger audience be aware that these shares are available for purchase or for sale. And so by staging them on our system, it enables the listing, the promotion of the availability of these shares on regulated trading platforms. And so what we serve as is a conduit between a spreadsheet, or a central database, which is over here, and a platform over there where a buyer can come in and browse for things they might want to invest in. People don't know that shares are available for sale in private companies, but they are. I mean, if you want to buy shares in any of the 1,000 unicorns, you could certainly go and buy them, but you don't even know where to start. Who do you call? These order matching systems in the US they're alternative trading systems, and in the UK, for example, there'd be exchanges like Archax. These platforms need a supply, in the form of shares which are prepared to be bought by demand. And what we do is we tee up that data so that it can be served up into these platforms.
This is different from what we've come to know and love as the pink sheets market, is it?
Yeah. It's different than the pink sheets market. First of all, the pink sheets markets, they definitely serve a need in the market for liquidity and small cap stocks. But there's also some kind of interesting activity which happens around pink sheets, which doesn't really happen in the digital asset securities market. In the digital, said politely,
I think I know what you're referring to. Yeah.
Yeah, said politely. There's no $2 billion New Jersey delicatessens in our market. But essentially, there's no short selling in digital asset securities. You might try to find a way to do it, but it's all basically sellers selling long and buyers buying actual shares. There's no rehypothecation. There aren't there's no puts and calls. There's no borrowed shares, etc. And so it's different than pink sheets.
Mm-hmm. Okay, so if I'm a target company of the Vertalo service, I don't want to go near the the pink sheets market because I don't want to be pumped and dumped or short sold up the wazoo. But I have got my share register. I've got my cap table. I want these securities to be bought and sold, but I've got it all on a spreadsheet. Is that the data? When you describe the business as a digital asset data management platform,
Yeah.
is that the data you're talking about, that register, that cap table,
Yeah.
that offers, that buy bid offer?
Yeah, I mean, it would be the stuff that's in, the data that is, kept at company's house over in the UK. Typically, it would be data that was held either in a spreadsheet or on a cap table platform like a Carta or a Pulley or a Certain over here. That's the base data. Sometimes it's just a spreadsheet, but not that often on the CFO or director of finance's computer. Sometimes it's data in a centralized database in a larger company. That's the source data.
Talking of centralized databases, I think the DTCC, the American Central Securities Depository, keeps a register, if you like, of securities available in the US. Do you have to work with them? Do you get involved with them in the work that you do with issuers or not?
Well, I'm on an advisory board for digital securities management at the DTCC, and I've been working closely with the DTCC for going on a couple of years now. The securities that we work in or with are not necessarily DTC eligible securities. DTC is taking a hard look at the private markets, and which is smart because private markets are bigger than public markets. But it's slightly orthogonal to that.
So the project the DTCC has to effectively reproduce what it does in the public markets, in the private markets, that initiative is not off the ground yet, as far as I understand. But that wouldn't lead to you having to integrate what you do with them in any way, or is it too soon to say?
Well, hard to speak at detail on this one, Dominic, for reasons of confidentiality, et cetera. But they are snapping into planning to snap into the private asset ecosystem, and I already have APIs that connect and enable the private digital asset ecosystem. So you can draw your conclusions as you will.
Yeah. Okay. So your clients don't need to worry about that. Now, I'm interested. You talk about digital assets. You talk about digitizing shares rather than, you did use the word tokenization, but it's noticeable that you tend to shy away from tokens and tokenization. Is there a reason for that? And if there is, what's the difference between the two in your mind?
So anytime we bring data onto our system, it is by definition digitized, because we use computer systems to manage this data, not pen and paper, and we turn them into data objects in our system. We started out being kind of tokenization maxis, and we thought that everything would get tokenized. The problem is not the tokenization itself, and I can get into why tokenization is extremely valuable. But the tokens that are produced from tokenization are different than, say, the ERC-20s that are traded on Binance or DEXs. They're every firm that tokenizes assets uses a different smart contract approach to it, and this causes compatibility issues at alternative trading systems and generally trading systems, because the data is not compatible, and it's it's kind of Tower of Babel type stuff. We don't need to actually use the token to facilitate trading. We send over long balances using APIs. I would argue that the primary benefit of tokenization today is actually in the creation of an immutable ledger of shareholders, an auditable ledger, a ledger which is resistant to accidental deletion or intentional corruption. When you tokenize an asset, you basically shard that database across all the nodes of the blockchain protocol that you use, and any change is recorded, meaning it's called a state database. You can see who owned what, or what wallet owned what at any time in the past. And so tokenization produces a superior ledger to a single entry cap table, either on a cap table platform or a spreadsheet or a centralized database, because of the reasons. Tokens themselves are kind of exhaust or a byproduct. They are a representation of ownership. And in some cases, if you're using a closed system, and there's some closed walled garden systems in our industry, which can produce tokens and trade them on their own platform, but sufficiently complicated so-called security token cannot trade everywhere, and it cannot do its own compliance, and that's a big issue. I do believe, however, that tokenization has a perhaps brighter future for collateralization than it does for the sale and purchase of digital asset securities.
So you are using blockchain technology, but you're just not a tokenization Nazi, as you put it at this point.
Maxi, but not Nazi.
Oh, Maxi, sorry, forgive me. I was
expressing
a fanaticism about
no, I'm not in the business of calling people names, but Maxi is a good name. No, tokenization is optional in our system, and it can be done in a matter of minutes, and we can tokenize anything which is divisible and adds up to 100%. And we've done, thousands of tokenizations, and it's very easy for us to do. But the value that it creates is primarily in the ledger today. And when the standards get created, then we'll be in a good position to actually use the tokens as the way people, the dreamers, want to use them for.
But I'm right to say you're using blockchain technology, and if so, which one are you using?
Ethereum and Tezos. Ethereum because everybody uses Ethereum for these things, and Tezos because it's cheaper and it's faster. And in full disclosure, we do have an investment into the company by the Tezos Foundation, which we got almost 4 years ago, but we're not required to use it. And when we recommend it, it's because of cost and speed, rather than anyone telling us what we have to do.
Okay, you're not a tokenization Maxi, but are you a digital Maxi, or can you service analog securities, by which I mean paper as well?
No, we don't deal with any paper. We deal with only dematerialized digital asset securities, and no one really uses paper, especially in private. There are some folks that still use paper, and there are plenty of paper certificates floating around, but that's mostly a public markets thing. And this, what we do is not going to into where we are today with the transactions per second throughput of blockchain. We're not taking this to public markets as a way to improve public markets. There's such a huge opportunity to use this technology to improve private markets, and private markets are already digital, so we don't have to deal with analog.
Now, you referred to APIs more than once in this conversation. They're the technique by which you're sharing data with the people that need to see it. What's the advantage of the API model? And in particular, I'm wondering here how effective it is at being indifferent to who is receiving the data. Do you not need to, in effect, standardize these APIs, or are they sufficiently flexible for anybody who needs to see data from you to accept and make use of that data? Are standards needed here with APIs?
Yeah, well, we have a standard API, so we can't create custom APIs. And so our APIs, we believe we can create a standard, at least within initially within a smaller ecosystem, but really moving data around. We've I think we've taken a page out of the SMTP book, which is the kind of standard for transmitting email data. You can think of us kind of similar to an ECN, or to SMTP and email, et cetera. And it's very, very difficult to scale anything without standards. And so we use APIs, application programming interfaces, to connect computers to other computers and move data in standard formats between them. And it's better than FTP, and it's, it works quite well.
And a potential user, where can they get those APIs? They just go to a library and download it, do they?
API.vertalo.com. You can go and look at the APIs there. We haven't open sourced them. That might be later. Same thing with our smart contracts. But API.vertalo.com if you want to learn about our APIs. And our whole system is built on top of our API. So if you wanted to build your own token issuance and transfer agent platform, if you want to build your own digital asset data management platform, you can actually license our APIs, and you can build on top of those, just like we built on top of our APIs, our own app.
I'm asking you about APIs because so actually they're pretty crucial to one of your core objectives, which is to increase interoperability between these ATSs, let's call them digital asset trading platforms, which you see as crucial to making these assets tradable and more liquid, making it easier for investors to move between these various platforms. Are APIs the central contribution you're making to that interoperability challenge, or are you doing other things as well?
I would say that the APIs serve to move data around that we have standardized on our system. So the APIs enable us to light up an ecosystem and work with lots of different parties in a similar way or identical fashion. So the how you format data is very important, how you transmit data is very important, and we're interested in setting standards in both how data is formatted, that means securities instruments, and how that data is transmitted to other parties.
You've been very articulate about the importance of a blockchain to the ledger. But I was interested to see that you also mirror that blockchain ledger onto a conventional database. What's the logic of doing that?
Well, it's less logic than that we're compelled to do it. Today in the United States, the securities regulators do not recognize blockchain as a single source of truth. They trust a central database, a spreadsheet, jottings on a cocktail napkin. Anything is more valuable, more truthful to the regulators today than so-called blockchain is, or distributed ledger protocols. We believe that will change, but we mirror on-chain from Postgres. And that's because we've done a lot of work with the SEC and FINRA, and we spent a lot of time with the regulators in general, and we're pretty bright line, and that's how they'd like to do it today. And I'd like to think that we'll be influential in getting them to accept what I think is the inevitable truth, that blockchain is a better share ledger than a spreadsheet.
But Vertalo is to some extent in fact to a very large extent, is a digital transfer agent, and that SEC insistence in effect on issuers continuing to use transfer agents, is that, you're making it sound as if that's not a problem for you, but I wonder, are you dependent in some way on the SEC continuing to take that effectively backward-looking view, or are we just talking about the difference between being digital and being non-digital here?
The thing about being a transfer agent is that it's very easy to get a transfer agent license. Anyone who's listening here can more easily get a transfer agent license than it can get a hair cutting license in the state of New York. Okay, it's harder to do that. The transfer agent rule book is relatively dense, but no one really understands what a transfer agent does. Private companies are not compelled or required to use transfer agents, but when you do start trading shares in like an active order book, on an alternative trading system or something similar. The SEC and FINRA have expressed a requirement to use a transfer agent, and as a result, we've had a lot of conversations with them. Basically it's books and records, and it's part of good corporate governance, and it's I don't think it's actually an added step. I would argue that custodying digital asset securities is an unnecessary step, because in our case they can't really be stolen. So and if they are somehow, they could be recovered or reissued. Really what we do is we enable the kind of normalization and stewardship of some of, if not the most important data managed by any company, which is who owns their shares. And broker dealers by law cannot manage this, and so people don't manage their ledgers at broker dealers. So that's where the transfer agent steps in.
Is there an irony at work here? And what I mean by that is that it's not difficult to find articles or papers which say that if anybody is doomed in a tokenized blockchain-based securities market of the future, it is the transfer agent. I've probably written a few such pieces myself. But here we have a case where Vertalo, which is using blockchain technology to create a new type of digital transfer agent, in effect you're reinventing transfer agency for the age of digital assets. Yes. Am I right to find that ironic, or did those of us who said the transfer agents are doomed in a blockchain future were just wrong?
I would say that the traditional transfer agents who don't operate on the same kind of data rails as a digital transfer agent like Vertalo, they're not nimble enough or inexpensive enough, modern enough to really deal with this data type. And they also have almost no experience dealing with private companies. And so I think that if you take a look at the companies in tokenization, almost every single one of them is repositioning themselves as a transfer agent. It's really funny. They used to really say, "Oh, I'm a token issuance provider," and I refer to them as TIPS. But almost everybody now claims that they're a transfer agent, because it's actually the orderly and regulated transfer of ownership from one party to another is a pretty important job, and it has to be. It's not an afterthought, and it's been a big part of the public markets. I mean, the public market transfer agents are multi-billion-dollar market cap companies, but they're plugged into a system which was developed almost 50 years ago, and under rules from almost 100 years ago, and we're bringing the best of that to the private asset market, and kind of trimming off the unnecessary kind of legacy friction that those things create at the same time.
Can I ask you a question I probably should have asked a while ago? Is the service you're offering limited to equities, or can it apply to any financial liability which can be digitized, bonds, funds, etc.?
Vertalo can work with any asset in any jurisdiction under any legal agreement, as long as it's divisible, and it's something that wants to be fractionalized and traded. So income streams, debt, collectibles, real estate, equity, any of those things. It probably needs to be divisible and add up to 100%. If it's, this is actually an interesting question, because there's a lot of folks who are saying, okay, all these ICO tokens, those are securities. Well, it's very, very difficult to manage a pool of something that is expanding and contracting, because you can't actually manage what percentage you own, and when it comes to things like pseudonymity, which is kind of a hallmark of crypto, it's very difficult to manage corporate governance when you do not know who your shareholders are. So anything where it's important or necessary to know who owns the shares and what percent they own and at what price they paid, that's a great job for a transfer agent.
So if I asked you to itemize the functions which an issuer can benefit from if they come to the Vertalo platform, what would be on that list, the functions you offer to the issuer?
So we work with companies, Vertalo works with companies from $0 all the way through to secondary liquidity. So we can aid companies in their primary capital formation, not as a broker dealer, but as an investor onboarding platform. We have something called Vertalo IO. We can help manage an existing ledger of shareholders, whether it's got 10 or 100,000 shareholders. We can tokenize that wholly or in part. We can normalize that data and can help convert it. We can also prepare that data for trading on a secondary platform, and we can manage the kind of ongoing issuer and investor relationship. So if you want to transform your company from a non-trading private company to a semi-private or semi-public trading company, we can help you from inception through secondary liquidity and beyond.
And if you were to itemize the benefits to issuers, I can see that this is going to be more economical than an IPO to start with. This is worth doing because it's not too costly for them. But what are the other benefits? They get an up-to-date register. The record date is always today, if you like. But does it also help them overcome the complexity of having these different liabilities out there, or trading on different platforms owned by different people? Is there a sort of reconciliation function you're providing as well?
We steward data. Okay, we're if you're an investor in a company, you want to make sure that your holdings in that company are properly documented, and that you're where you should be on the cap table in terms of your ownership and your rights and your ability to transfer, etc. We provide an important kind of trust type role, not like a trust company, but we increase the level of trust between an issuer and an investor. While the system can enable extreme transparency, meaning you can see balances in wallets, we also balance transparency with privacy and security, and we developed keyless custodial wallets. So when we do an issuance, we create wallets that have never been seen before. So that means that while your holdings may be on chain, they're in a wallet address that no one's traded with, so no one can infer your holdings. In our case, we don't necessarily trust pseudonymous investors, and we don't necessarily trust people's ability to maintain private keys. And so we make it so that people know that they don't have to worry about their so-called digital asset security tokens being stolen, because they can't be stolen from our system. And if somehow they we're not sure how that would happen. We can reissue them and shut out the other ones. So it's really a factor of confidence and trust, and that's when you work with a company like ours, you're looking for that.
And the benefits for investors are, as you've described, they too can trust the data. They have custodial wallets. You touched earlier on ability to use these assets as collateral for other financial liabilities, loans, for example.
Yeah.
Anything you'd add to that list? Benefits for investors?
I think that's a great place to start. We're really interested in managing one piece of information, one line, one row, and that is who owns what, when they buy it, at what price, and what restrictions are on that. And can it be traded or not, and where, and what was the last price paid. That's what we're interested in managing, and I think that's what investors are interested in knowing, and issuers and investors need to agree on that. Now the next thing, where this industry is going, in my belief, very strongly, pretty strongly held, pretty strong conviction, is the use of kind of DeFi lending pools for real world assets to facilitate share lending. I think that share lending in private markets is very nascent. There's not much of that. Occasionally people use private shares as collateral, but it's very manual, and it's very it's not standardized.
Now, one of the earliest comments you made, almost en passant in this conversation, was that you had experience of building ecosystem infrastructure, I suppose, for ecosystems of non-competing participants in a marketplace. I notice you have partners as well as clients. Now, how does a partner differ from a client?
So in our world, partners, everyone's a partner, first of all. Okay. So we work very closely with folks to help them get the most out of our ecosystem. And what that means is that they're because we connect to other platforms, we are, whether that's an issuer, their website raising money, or whether it's a trading platform, or whether it's a custodian, we have to work together. Okay. Are we a vendor to issuers? Absolutely. Are we a vendor to investors? Well, they don't pay us, so we don't get money from investors in their portfolio accounts. The issuer pays for that. But I kind of like the peer relationship with everybody, because it's highly cooperative and it's highly integrative. And when something is collaborative and integrative, and both parties have to play a role to make it work, I call that partner.
But you're also working with third-party businesses, aren't you? What do they bring to your offering, and what types of third-party businesses are you working with?
So we work with, for example, Netkey. We've integrated their platform into Vertalo, and they do KYC and AML. For accreditation, we partnered with a company called InvestReady, and they do accreditation. We partnered with DocuSign for document signing for any of these legal documents. We partnered with North Capital for escrow and custody, as well as secondary trading. We've got 5 ATS partners, including Texture Capital, SimBridge, Shift Markets, T0, and North Capital's PPEX. And so those are generally our partners. And then we've got some broker dealers and RIAs and kind of capital advisors, too many to name, and we work closely with them, and a bunch of crowdfunding platforms that are plugged into us. And again, it's partner because we help each other, and those are the kinds of partners we work with. I mean, we don't raise money for anybody, but we help people manage the fundraising process, and we don't provide a marketplace. Our partners provide marketplaces for our issuers, investors, and the APIs are the connective fiber for this partnership network.
Could we talk a little bit about where you've got to now? Obviously, the XY Labs Reg A and Reg D issue, that was a flagship issue for Vertalo. Yeah. I wonder first what you'd highlight about that issue in particular as being important, but secondly, what's the pipeline look for other issuers at the moment?
So XY Labs was really interesting. They initially worked with Carta, and that was kind of earlier in their career, and they wanted to go get secondary liquidity to them, but apparently that wasn't possible, and they moved over to Broadridge, which is a large financial technology platform, but they couldn't make their shares liquid through their partnership with Broadridge. And so what we did for them was we enabled their 24,000 or so shareholders to move their shares from an untradeable state and deposit them onto Vertalo so that they could trade on T0. And so we took a whole bunch of different share classes at different prices and different times. We were able to kind of do ETL, extract, transform, and load operations, and get all that data onto our system and stage it so it could be traded on the T0 alternative trading system. And this turned out, so far, it's pretty big. I mean, with 24,000, by far the largest digital asset securities listing yet to date, and it only because our system is meant to scale, and that we're able to do pretty deep data transformation work, that we are able to do things that multi-billion-dollar companies could not do.
So you've proved that this works. You can take a bunch of existing securities, migrate them onto, in this case, Tier 0, and it was clearly worth doing for the issuer. What's your explanation of why the security token market, if I could call it that, but call it digital asset market, if you like, why is it failing to take off? The benefits seem to be clear, the savings are equally clear, yet it's not happening at the scale people would have predicted 2 or 3 years ago. Why is that?
Well, I'll give you a couple of reasons why. First off, in the early days, people were focusing on something that it's called security token offerings, or STOs. Mm-hmm. And it was all around raising money by selling security tokens in early stage offerings. Well, if anyone who's invested for any amount of time knows that 90x%, who knows what the number is, of early stage ventures fail. And that is, if you invest in those things, you should do it with an understanding that you could lose everything. Security tokens don't make it easier to raise money. It early on, and when I say early, 2018, 19, et cetera, it attracted a lot of issuers that were looking at so-called security tokens as a halo effect, something to make their offering sexy to folks that were interested in crypto. But basically, essentially, it attracted the wrong issuers, and a lot of those offerings didn't go very far. So fast forward to today. The other thing is that these early offerings were all traded peer-to-peer, wallet to wallet, without a transfer agent, and without being listed properly on an ATS, and it didn't solve the marketability problem either, and it created a technical hurdle for people to trade these things. Trading a security token from your wallet to someone else's wallet is basically a Mexican standoff. Do you send the tokens first and then get the money, or do you send the money and then get the tokens? And that was kind of version 1. So there was a technical hurdle. There was a quality of issuance level issue that kind of we got some black marks and took some black eyes from, and we didn't really get into that market ourselves. What it really is that the problem is not tokens, the problem is liquidity, and that's what we're focused on. This technology is great for facilitating secondary liquidity in previously illiquid assets, but not because of the tokens, but because of the connections between these systems. Using blockchain as a ledger, using APIs, more trustful standards. It provides a great platform to take a liquid asset stored on a database or spreadsheet and transform it to making it tradable. And that's where we're focused. And then you actually have to have offerings. And this is a really critical problem. I mean, if you have something that no one's interested in investing in, blockchain will not fix that. Security tokens will not fix that. You need really high quality. And then, there's folks who just can't invest in things that have the word token in them. And I think that, depending on where we are in the crypto cycle, token is either a dirty word or it's got shine to it. And, but just tokenizing something does not make it more investable. In fact, it may make it less so.
Mm-hmm. I'll come back to that point you've just made about the crypto cycle in a moment. But one reason often advanced for why security token offerings haven't taken off is regulatory uncertainty. Now, you are SEC registered, and I wonder why you thought it's important to go for that registration. But also, what other regulators do you work with, and what do those regulators like about what you're doing, and what do your clients like about the fact you're regulated?
Well, first of all, that regulatory issue that people talk about is nonsense. There's no regulatory issue. We're enabling the trading of private assets under Reg D, Reg S, Reg A, Reg CF on SEC regulated alternative trading systems, and we don't have any regulatory issues. Now, of course, I have a co-founder who's former SEC, who was key in the authorship of regulation ATS. So we understand the regulations really well because one of my co-founders wrote it. And we've spent a lot of time with the SEC and FINRA, less with the CFTC, less with OCC. But this really just comes down to working with the SEC and FINRA, and we're not FINRA regulated because we're not a broker dealer, but we do assist in CMA filings. This is not, the regulations are not an impediment. Quality is an impediment. There's no, if folks think that, look, I think accredited investor rules don't make any sense. Okay. Maybe that's what people think is the regulatory impediment, but that doesn't apply just to digital asset securities. That applies to all private securities. So that hasn't held back venture funding or venture investments. So I think a lot of that's a bunch of nonsense. I think that there's a lot of folks who want to cut corners, and they want to do things on DEXs and in ways which are not investor friendly, and those are the ones who complain, and that's just an excuse. I don't buy it.
Now, back to that crypto cycle point you raised. It's obviously been a very difficult year, November 21 to November 22 in the cryptocurrency markets. And another thing people aren't particularly clear in their minds about, not all people anyway, is the difference between, say, the security token markets and the cryptocurrency markets. They're kind of all bound up in one. And so when people see FTX fall over, they think, oh my goodness, that's the end of the story for security tokens as well. Now, that's clearly wrong, but I don't know, what point do you think we are in the cycle is point one, and point two, which is more important in a way. Where do you think all this is heading? What's your vision of the end state of the digital asset markets if you look 10, 15, 20 years ahead?
Well, I try not to use the word end a lot. So let's go to FTX. FTX was a case of bad stewardship. The best thing that you could say would be that it was there was no stewardship and no accountability. That's the best thing that you can say. I think everyone has said enough about FTX, but clearly there, misuse of funds and poor record keeping and lack of transparency and who knows what else. But you can go find that out. I think that what we're doing here at Vertalo, and what I think a lot of folks are trying to do in generally in this digital asset securities ecosystem, is to provide both security, transparency, and privacy, trust, but also tradability and transferability. And if you're holding these things, you've got to embody all of those values. I think that I wouldn't have started this thing if I didn't think that all private assets want to be tradable. It's a global problem. It's irrespective of asset class, of jurisdiction, of the structure of an asset. People invest in private companies to either get paid a dividend or to see it grow and then sell it at some point. So anything which makes a valuable asset easier to trade and transfer, I think is a societal good. And specifically, I would like to see a third way to liquidity besides M&A and IPO for private companies, so that long-suffering employees can get some liquidity for all their hard work as indentured servants for people like me, that eventually they can, despite being underpaid, they have a windfall at some point. And seeing a more fluid, open market in private equities, specifically venture funded equities, that would be a great place to land. And I think that we're getting there.
I wondered then if you were about to advocate DAOs.
Never.
As a corporate model of the future, to give those indentured servants that you referred to inside these large corporations some kind of equity reward for the effort they're making.
I'm not sure how you create a DAO without centralization. I think that sunlight, one of the things that by putting owners on an immutable ledger, which can be inspected with a block explorer, which has an audit trail, which is subordinate to legal documents, I think that's good. I think the problem with DAOs, and I think this maybe ultimately will be fixed, is the problem of pseudonymity. It's also the problem of central control and voting. And DAOs can't create themselves out of thin air. So as long as there was a team that started something, there's a force of management, an executive function, which has its own dog in the fight and its own interests. And I just think that humans, and this is not a bad thing, humans are inherently selfish and greedy, and they are, we've seen effective altruism at FTX, and what that means, meaning stealing your money and giving it to other people. That's what effective altruism means. Mm-hmm. I don't know that the DAOs are able to conquer human nature, and there's a reason why you have preferred shares and you have common shares, and there's a reason why you have corporate governance, the reason why you have boards, and the reason why mob rules are always chaotic. So I'm not sure that how a DAO can attain its vaunted benefits today, and maybe in the future there's a way for this to be done in a way which is not creating a pseudonymous cabal that you, as an investor in the DAO, you just don't even know about.
Mm-hmm. Yeah, I guess existing ownership structures are not just conspiracies. They exist for real reasons and are based on experience. Yeah. Could we close, Dave, with just a couple of questions about the status of your own Vertalo business? My first question is really about how you get paid. You've explained you don't get paid by investors. So who is paying you? What's the commercial model?
Yeah, we're a B2B SaaS digital asset data management system. We're allergic to transactional fees. We license our platform to broker dealers, RIAs, investment banks, real estate funds, fund managers, or groups of entrepreneurs that want to build their own digital or tokenized platform. And so we license the platform. And the folks that we license the platform to, the entities, they work with assets or issuers of assets. And so those assets, the issuers sign transfer agent agreements with us to manage their share ledgers. And so our master licensors, who are, again, broker dealers, RIAs, et cetera, license our platform, and they bring us assets who pay us to manage that data. So our clients pay us to bring us clients. And it's it's a pure B2B SaaS license model. We don't take a percentage of assets. We don't take transactional or transfer fees from individuals or investors, et cetera. So it's a B2B SaaS system.
My final question is about, I guess you could call it the capital position. If we look at what's happened in the cryptocurrency markets over the last year, but perhaps even over the last 10 years, every hack and every theft, not just FTX falling over a couple of weeks ago, but everything that's happened in those markets, to which your business is inextricably linked, rightly or wrongly. And it ought to be good for your business in the sense you're transparent, you're secure, you're respectable, you're regulated, and so on. But I wonder if it has been. It may be too soon to say this, whether you feel it's good for your business, and if it is, whether you need to raise more capital, what you'd spend that capital on. I know that you're down to Series A,
Yeah.
raised 7.8 million. So what are the existing shareholders thinking now? Is it time to double their bets, or are they all feeling a bit cautious? And whatever they're feeling, what do you think are the next investments you need to make to capitalize on what's happening in the marketplace?
So we're uncorrelated from the crypto markets, both kind of philosophically and technically. We other than Coinbase, who's an investor in us, and Tezos,
and the clients and the shareholders understand that, do they? I'm often amazed at how people seem to jumble these things up, and indeed some very respectable firms were invested in FTX, weren't they? Clearly without doing much due diligence.
Yeah, I mean the folks that invest in us are typically folks who understand startup velocity versus trading velocity. There's a lot of VCs out who are investing equity in DeFi projects to get governance tokens. We never had a governance token. And they didn't really care about the equity in the company. They just wanted the governance token. Those folks were never interested in investing in us because we didn't have a liquid token that they could dump on retail later. And there was a lot of that in the DeFi kind of Web3 investing world. Still there. They always want that token. And it's a great way for them to get a quick return. And our investors are just not interested in that. We're going to continue to invest in building a platform which connects and enables a digital asset securities ecosystem, which engenders trust across the landscape in private capital markets, and that ultimately solves a very important societal problem, which is getting liquidity for investors and employees at various ventures. And that has a lot to do. We just add more trading platforms to our network. Creating easier to use systems for issuers and investors. And then, one of the big things we'll be doing is, I think, spending more time on collateralization of real world assets. And that's kind of where we're going. But it's really in, safety scale, security, and usability, because ultimately, we're serving normals. It's got to be trustful. It's got to be easy to use. It's got to be more like AOL and Coinbase than it is like MetaMask and Uniswap, which are kind of beyond the scope of a lot of normal people. Not to say those are bad things.
Yeah. Well, Dave Hendricks, thanks very much for taking the time to talk to the members of Future of Finance.
Well, Dominic, thank you for having me. And if you have any more questions, you can always find me.